Hello everyone. I have been covering NIO stock for a while, but in today's video it will be a tutorial for options call buy and with specific example to the NIO stock. And the reason I want to do this tutorial with an example with the particular stock in mind is it's because you are probably already following NIO stock for a while, maybe buying and selling this stock. It will be easier for you if you want to learn about the options trading. So let's start with what the current price of the new stock is on Friday that ended. Today is 16th August, and on 14th August we had a Friday, and the stock ended at 13.10 price here, right here. And so what we are trying to speculate is we are expecting that this stock price is going to be high, and not only high but very high, because and the reason for as a bullish a trader is that there are some good news coming in the next coming weeks or next couple of months. For example, in another video, I had showed that the car sales numbers are going to be released on in the September first week. Then we will have the EC6 delivery starts in September. Then we will have the September numbers, which will include the new car sales number for EC6 model, coming in October. So, and then in October we will have the expectation that the results will be announced in mid-November. So all those things, a series of positive news could propel the stock significantly high. And of course, my speculation could be incorrect, or it could be overhyped, but that's not a purpose of this video. But I'm saying that I'm building a case for why it could uh, why I could be playing the call options, and that you will learn in a while. So I go to my broker account, or even go to finance.yahoo.com, or any other places where that shows the option prices, and that shows, and there are two things in you will, that you will observe. You can drop down of the option price of the different dates. You drop down the October 16, 2020, which is Friday, and you also select the or look at the strike price, which is $20, and then the price of the option for that particular date and that particular strike price is 50 cents. And what does that mean? It means that on October 16th, if the strike price is it reaches more than 20, then I have a right to buy that stock because I paid 50 cents as the premium. So these things could get intimidating for you at a glance, but let's understand it with an example. What's going to happen on October 16, 2020? Let's say what I do is, I just, in order to learn, because I don't understand, I just go ahead and spend 50 cents. That's for one option, and one option consists of 100 shares, which means that I go ahead and spend $50 for the sake of learning. I spend $50, and then that gives me a right to buy 100 NIO stocks on October 16, 2020. Now the time moves by, different news comes, and the news becomes very positively, stock price starts going very high, and those things happen. I'm not saying that will certainly happen, so don't pull me if that does not reach that high. Now on October 16, 2020, the stock price reaches $24. Very little chance of happening, but that can happen because of you don't know. So what I do is I I had spent $50. Now it has given me the right to buy those shares. Obviously, I do buy this $24 stock, and that stock I will be able should be able to buy at the strike price, which is $20. So my gain will be, I can sell it right away. Let's say on 16th itself, I sell those stocks. So I will sell it at $2,400 minus $2,000 that I paid. Remember, one option price, and for that particular consists of 100 shares. So I will sell it for $2,400. I will I It gives me a right to buy at $22,000, and but I also pay $50 of premium for that. So my net gain will be, if you are talking about in a single share, then it will be 24 minus 20 minus 0.5, or 4 minus 3.5, or $3.5. Or for 100 share, this will be $350. So I make a profit of $350 by risking $50. So $50 risk, take a $50 risk, you could potentially get $350. Now learn about case number 2. Let's say the stock price on October 16, 2020, it increases, but it does not hit the $20 price that was my strike price. So what happened? Now I lose 50 cents, that $50. That gets forfeited. I lose all of that $50. Let's get another example, which will be, then you will understand the implications of these options. Let's say on 16th October, the stock price, instead of going up, it starts going down because people think it's overpriced. It's also because some people start thinking that maybe its price is embedded into it. There's no more reason that it should go even increase it, and its stock price goes actually down to $12.50. What happens? You still lose those $50. Now consider a case. Why would you get into the option trading, especially the call buy? Let's say this. In a regular trading, you think that $13.10 you buy this share, and then on October 16th the stock price actually goes down to maybe $10. So you lose $310, and that's a big money to lose. So what you do instead is, but if you had purchased a call options of $50, you only lose $50, even though the stock price goes down from $13.10 to $11 or so. You don't lose $210 when its stock price goes down. So your losses are small if the stock price goes down steeply instead of increasing. That's the one case of call buy option. The second case, the stock goes steeply up. That's when you make a profit, and then your profit is leveraged because by investing $50 you make 7 times the profit. So that I hope you, if you start looking at the charts, start looking at the, click on the options tab in the finance.yahoo.com, and then click on the different, drop down the menu that says strike dates. There are different strike dates. For the first 2 months it's weekly, and then it shifts to monthly, and then after 6 months it goes to like yearly or so. And then for the different, the first half of that column is call options, and the bottom is the put option. I will have another option for the put option. So the way I have so far given this tutorial, it looks like you need to wait all the way until October 16th to see your results that you passed or you failed. In reality, this is seldom done. What we do actually is we track the prices of the options in the same way we track the prices of the stocks. The option prices, they also vary day to day, hour to hour, in the same way as the stock prices. And then we can buy and we can sell the options on a day to day basis, or on the same day if you are doing day trading, or maybe on a week or two. So before we understand that concept, let me ask you one question, and if it looks difficult, um, just pause and think about it. By the way, even before I go to this question, let me ask you some more question here. If instead of $20 strike price, you may think that 20 is too high. It's not going to be that high. It cannot go that high on October 16th. Let's put it more realistic, a $15 strike price. Because that's more realistic. There's a very good chance that it's going to hit that price, $15, with the two couple of good news coming up, at least at some point of time. Maybe right after the September's car sale results. Now, what do you think is the price here going to be of that option going to be? Is it going to be more than $50 or 50 cents, or is it going to be less than 50 cents? Just think about it as I open my laptop to actually see what that price is will be, and also think about from the perspective of the person who is selling this call, and I will come to that as well. It's very important that, as in the chess game, to learn your opponent's strategy, what he is thinking about. So if you have guessed it right, and I'm looking at my laptop, at currently the option price for $15 is higher, and obviously, because if it were same, you probably would have purchased the call buy for $15, because for 15 cents, if I could get a $15, probably I would have been happier. Even I would have taken this. For $20 strike price, I feel like 50 cents, I'm probably going to lose that. But 50 cents for $15 strike price, that's a good price. Most likely I will win, because it may hit like $16, $17 on some of the days. And my 50 cents could translate into a $1.5 to $2 profit. Very, very good chance. Unfortunately, for $15, it's not 50 cents. It's higher. NIO is still a speculative stock, in the sense that I looked at the Yahoo Finance just right now, and that price is $1.41, which means that the break even is going to happen at $16.41. You make a profit only when the stock price increases above 16.41, so as to say between now and October 16th, and it's slightly more complicated than that, but I think you got the idea that if your strike price is just above your price, if your strike price is just above your current price of the stock, the call option is going to be expensive. How about $14? That's going to be even more expensive. There's a very good chance that it will hit $14 maybe as soon as in a week. So that is $1.17. So if I make it $14, the current price is $1.17. So that's the stock price, options price of NIO stock. So just stay with me for a little more time. If you want, you can take a pause, look at the stock prices of the call option for NIO stock for different dates and different things. So I brought a variable that's called how the call option price varies with different strike prices. Now there is another variable, and that is October 16th, 2021. What happens? How does this stock option price changes if I move this date a little farther, and as a call buyer option speculating or being bullish about it? What happens if I move this to maybe after November 15th? Because in November 1st we'll have another car sale data capturing the September October car sale for EC6, which will be further rising, hopefully, with the whole expectation that the EC6, the new car launch for NIO, it gets even better. And then we will have around November 15, the third quarter results comes in, and with the speculation that the third quarter results are going to be better. So I have January 15th as, or maybe November 20th. So I have a date on November 20th, 2020. Okay. Now I look at the strike price of $20, and I would like November 20 better, because then I can capture the two more events, and the chances that it hits $20 really gets brighter. Unfortunately, the problem is this price is no more 50 cents for that. It's $1.15. That's what I saw in my laptop right here. So what should I do? Should I buy a call for October 16, $20, or November 20, $1.15 and $1.15? This will make my break even go to even higher at $21.15. But it increases the chance of capturing those two events, and maybe that's better. I don't know. How about November 20th, 2020, but the strike price, let's keep at $14. This guy over here, $14 strike price on November 20th, and that call option price is $2.45. This means that any time between now and November 20th, if the stock price goes above 16.45, I make a profit. And I think that's a very good speculation. It's a reasonable speculation. It takes money, like you lose $245 if the stock price does not go beyond 16.45, but it also increases the chance of you making some money, maybe much more money. So there are more dimensions to the call options, call strategy. There is a strike price variation, there is a time factor, and the call options itself keeps moving. So I hope I'm making sense. If not, you can rewind and look at this video again, and maybe while you are look at the options prices, and watch the movement of the options prices on a day-to-day basis. Now I have a question for you as an exercise, so you could stress your mind and see if you can answer that. On 8/22, current, assume today is 8/16th, it's an older date, today is 8/16th, but on Monday the stock market opens on 8/17th, and then the price starts going up from current $13.10 to $15. Now, does the option price, and let's, for the options price, let's pick up this option price. I'll remove all these, which was 50 cents for $20 strike price. What's your thinking? Does it go up or does it go down? My thinking is that it's going to go up, because at $15 now you come closer to the strike price. Let's say I will make it question even more clear. Let's keep it $18. Make the question a little easier to understand. Or maybe $19. That makes it even better from the understanding point of view. If the strike price becomes $19, then let's say I am sitting on 8/22, I'm a fresh buyer, and if it has already hit $19 and right on the 8/22 itself, the chances are very good, much better, that on by October 16, 2020, the option price will increase. It may increase from 50 cents to maybe $1, $1.50, or whatever, let's say. So, why will increase? Because now I have a much brighter chance of getting the hitting the $20 price, so I am willing to pay more premium to it. So the option price is going to increase to, let's say, $1.5 from 50 cents. So ordinarily, let's keep this date a little much farther so that we have a lot of time. In that case, generally, as the stock prices increase right here, the option price, the call option price, also increases. And let's say I don't have to wait all the way until October 16th to make a profit. What I could do is on 8/22, I could just sell this option. I bought this option for 50 cents. I can sell this option for $1.50, make $100 profit. One option price is 400 shares. So I can make $100 profit in a week. So options are usually not exercised all the way to the end, but at the point where you see a reasonable amount of profit, you actually trade that option. If you have purchased the option, you sell it. If you have bought the options, and so on. So basically you trade the option. So now let me ask you another question. On 8/22, the price goes down from $13 to $11.50. Does option price increase or does it decrease? Obviously, if I'm option buyer, it is right now at $11.50. The chances of it now hitting $20 is very little. So obviously, people will be willing to pay very little premium for that. Instead of 50 cents, it may go down to maybe like 20 cents, maybe 15 cents. Now the chances are much higher that you are going to lose all your $50. So instead of waiting all the way to the expiration, you may actually sell whatever little value left, and instead of losing whole $50, you actually lose a little bit, like $35, and sell your option. Okay, You cannot always win. Sometimes you have to lose. Your prediction was not correct. Your prediction that it will go to $20 was not right actually. You were over enthusiastic about NIO, and it happens. It happens all the time. People flow because the whole stock market is going up. People come into flow because they are over enthusiastic about the stock they buy. But then that happens. That's the game. So this gives you a good feeling of the option price movement with respect to the stock price movement, option price movement with the dates. And before I one last thing of I wanted to be clarify you is how this stock option price moves with respect to the time. So let's keep other variables constant. Let me keep the price constant. Price stays $13.10, which was the August 14 price. And I keep the same date, strike date at October 16. And on 8/6/14, the stock price is 13.10. A week passes, stock price stays same. Another week passes, 8/28, stock price still stays same, $13.10. My question is, what happens to the options price? What will be the options price on 8/28 for the October 16th strike date, assuming it's 50 cents today? So, from a buyer's perspective, understand this. On August 14, we have much larger period of time. There are better chance of stock hitting that price. Now you have very little time left, and the chances get reduced if the price did not increase in these 2 weeks. The chances get lesser that the stock price will increase in that price. So the price of that option will decrease. You will be willing to pay very little. To make it more clearer, let's move it even further. Let's move it to September, maybe 20th. And the stock price is still $13.10. The September results are out. The car sales numbers are out. Whatever EC6 cars, those news are out. Most of the news are out. Only one news is left, that's September car sale number. That will also come, it will be known. Now the price is still $13.10. The chances of this going to $20 has become very slim. There's absolutely very little chance that will go to. Obviously, you will be willing to pay very little. Instead of 50 cents, you will pay only maybe 12 cents. What does that mean? That means that my option price has gone down, which means that if I sell the options, I will lose, or more likely I will lose those $50 if I wait all the way until the strike price. So I covered the option buying part, but this is only just one of the 4 strategies, and I can assure you that if you only learn this, you are more likely to lose. You need to understand call sell, you need to understand put buy, you need to understand put sell. This you need to understand all four strategy to be able to to fully uh, decide which one will be the best option to do, and you also need to have a strategy, and I will cover those in my other videos. If you subscribe this, you will have other videos including my real time trades in NIO and other stock showing my options trading. Thanks for taking a look.